Every single person who invests, whether it's $100 or $1 billion, is trying to solve the exact same puzzle. How do I get the absolute best return possible while taking on the least amount of risk? It's the central tug-of-war in all of finance, and for decades, the smartest minds on the planet have been trying to crack the code. Well, today, that's what we're going to do. We're going to dive into the amazing theories that built modern investing, from Nobel Prize-winning math all the way to the weird glitches in our own minds.
So let's just ask the big question right up front. Is there a secret formula, a perfect scientific way to invest your money? For a long time, the world of finance was convinced the answer was yes. They believed that if you just had enough computing power and the right equations, you could solve the market. And our story starts right there with that hunt for the perfect formula.
And that search led to this incredibly elegant idea, the concept of a perfect portfolio. Now, this wasn't just some gut feeling. This was a breakthrough that won a Nobel Prize and was supposed to give every investor a clear, mathematical roadmap to success. It all started back in 1952 with an academic named Harry Markowitz. He came up with this idea that was honestly revolutionary. He said, stop trying to just pick good stocks. The real genius is in how you combine them. See, his modern portfolio theory showed that a portfolio's total risk is actually less than the risk of all its individual stocks added up. The magic ingredient here? Diversification.
Okay, so to really get how this works, you have to know that there are two kinds of risk. First, there's systematic risk. Think of this like the weather. A hurricane or a recession, it affects everybody. You just can't get away from it. But then you have unsystematic risk. This is like a single company having a specific problem, a bad product launch or a scandal. And that kind of risk, well, that's the stuff diversification can almost completely wipe out. And you can really see the power of this idea right here. Look at how that total risk line just plummets as you add more stocks. You go from 1 stock to 5 to 10, and the company-specific risk just vanishes. And what's kind of crazy is you don't need hundreds of companies. The theory shows that with just 15 to 20 well-chosen stocks, you've pretty much eliminated all the unsystematic risk you can.
This brings us to what these theorists saw as the holy grail. It's a curve called the efficient frontier. Basically, every single dot on that line is a perfect portfolio. It's the one that gives you the absolute maximum return you can get for that level of risk. And according to the theory, a rational investor would never pick a portfolio that's below that line. I mean, why would you? You could always get a better return for the same risk just by moving up to the frontier. So, modern portfolio theory gave us this beautiful, logical framework. But it accidentally opened up a huge can of worms and led to an even bigger, much more controversial question. If everyone is being rational and we're all using the same information to build these perfect portfolios, how could anyone possibly beat everybody else? And that brings us to the efficient market hypothesis, or EMH. This is like the ultimate buzzkill for stock pickers. The theory basically says that at any given moment, a stock's price already reflects every single piece of information out there about that company. That means there are no secret bargains to find. The price you see is always the right price.
Now, EMH kind of comes in 3 levels. The weak form says looking at past price charts is pointless. It's like trying to drive forward by only looking in the rearview mirror. Then you've got the semi-strong form, which is what most academics tend to believe. It says all public information, like earnings reports or news articles, gets priced into a stock almost instantly. And finally, there's the extreme strong form, which claims that even secret private insider info is already baked into the price. If any of this is true, trying to outsmart the market is basically a waste of time.
Okay, so let's just play along for a second. Let's say we agree that you can't consistently beat the market. Well, that totally changes the game, right? The question isn't, how do I get rich anymore? Instead, it becomes, all right, what is the fair return I should get for the amount of risk I'm taking on?
And that's exactly what the Capital Asset Pricing Model, or KPM, tries to answer. It gives us a formula based on something called beta. Just think of beta as a stock's spiciness level. It measures how much a stock tends to jump around compared to the overall market. A high beta stock is a riskier, more volatile ride. And the core idea of KPM is super simple. If you're gonna get on a riskier ride, you should demand a higher reward for it.
So for decades, these 3 theories, MPT, EMH, and CAPM, were pretty much the gospel of finance. They were neat, they were mathematical, but they all relied on one huge assumption, that investors are rational robots. But then we kept seeing things in the real world, like giant market bubbles and sudden crashes, that these perfect theories just couldn't explain. And that's when a new field came along and pointed out a pretty major glitch in the system. Us.
And say hello to behavioral finance. This field basically grew out of the cracks in those older models. It looks at traditional finance and says, hey, you built a beautiful system, but you forgot to include the most important variable, the messy, emotional, and often totally irrational human brain. It doesn't say the old theories are wrong, just that they're incomplete.
And really, it all boils down to this. We think we make decisions with spreadsheets and logic, but so often we're driven by gut feelings, by fear, by greed. We take mental shortcuts, and all of these human quirks create patterns in the market that the purely rational models just can't account for.
Behavioral finance has cataloged all these little mental traps we fall into. There's herding, that's basically FOMO, right? We see a stock going to the moon and we pile in just because everyone else is. There's anchoring, where we get obsessed with a meaningless number like the price we first paid for a stock. We get overconfident in our own genius. And maybe the most powerful bias of them all is something called loss aversion.
And just how powerful is it? Well, this is where it gets wild. Research by these two psychologists, Kahneman and Tversky, found that the psychological pain of losing a dollar is felt about 2.25 times more intensely than the pleasure we get from gaining a dollar. Think about that. This one little fact explains so much weird investor behavior, like why we stubbornly hold on to our losing stocks, just praying they'll come back to even.
Okay, so what does this all mean for us? On the one hand, we've got these perfect, logical, mathematical models. And on the other hand, we have the messy, complicated reality of human psychology. So how do investors in the real world actually navigate all this?
Well, it really splits everyone into two big camps. If you're a believer in the efficient market hypothesis, you become a passive manager. You say, look, I can't beat the market, so I won't even try. I'll just buy a low-cost index fund that owns the entire market and match its performance. But if you think human psychology creates mistakes and opportunities, you become an active manager. You believe you can find those mispriced stocks and actually beat the market.
And even within that active camp, people have different game plans. A top-down manager is like a general looking at a map of the world. They start with the big picture, the economy, interest rates, to decide which industries look good, then they pick stocks. But a bottom-up manager ignores all that macro noise. They're more like a detective just hunting for a single amazing company, believing that a great business will thrive no matter what the economy's doing.
And this leads to all these different tribes of investors. You've got value investors, they're the bargain hunters, sifting through the market's junk pile looking for a hidden gem. You've got growth investors, they're the futurists, trying to find the next Amazon before it becomes Amazon. And then there are momentum investors, who are basically like surfers just trying to catch the biggest wave, betting that whatever is hot right now will stay hot.
For the longest time, that was the whole debate: rational math versus irrational psychology. But in just the last few years, a powerful third factor has stormed onto the scene, and it's adding a whole new, complicated layer to the investment puzzle.
And that factor is ESG. It stands for environmental, social, and governance. A huge and growing number of investors aren't just asking about risk and return anymore. They're also asking about impact. They look at a company's environmental record. What's its carbon footprint? Its social record. How does it treat its workers and its community? And its governance. Is the company run ethically and transparently?
And that leaves us with a really fascinating question for the future. You see, the last half-century of investing was defined by that cold, hard trade-off between risk and return. But as we look ahead, is the big debate going to be about profit? Or is it going to be about profit and purpose? That's the question that's going to define the next 50 years of investing.